Today we are going to be looking at debt, whether it's good or bad, how to manage it, the different types of debt, all of that fun stuff. I'm Jolisa Gonzalez and this is Sam Halal, and today we are going to be exploring all of that fun stuff. So in previous conversations, you have always told me that debt doesn't always have to be a bad thing. Can you go in a little bit on why that is the case in some situations?
As a matter of fact, I would go to the extreme of saying that that is very good if it's done properly. So think of these multi-billion-dollar companies out there that are sitting on a lot of cash, yet they still go out and borrow when it makes sense for them. So that cannot be bad all the time. Sometimes it makes sense. Also, you got to make sure that you're maintaining the spread into your advantage when you're going out and borrowing, and that you're borrowing for the right reasons. If it's something that is worth borrowing for.
Okay, so I know that you mentioned that borrowing can be beneficial for companies. What is a way that these type of companies can leverage it to their advantage?
Well, in the corporation's example or business example, businesses can go out and borrow money. And one of the biggest advantages they have is that the cost of the debt, the interest that they pay to their lenders, is tax deductible to them. So it is important for them always to maintain a balance of how much of their capital is equity versus debt, because they always monitor that capital and ensure that they have the right ratio for their operation.
So you did a pretty good explanation of borrowing for the right reasons when it comes to companies, but looking at a lower scales for individuals and their families, what would be considered a right reason in some circumstances?
Sure. There's really many different ways where borrowing makes a lot of sense for an individual or for a family. The most obvious one would be when you're purchasing a house. Usually that's the biggest purchase any individual or any family does in their lifetime. And a lot of times it's a big number. So it's easier to go out and borrow against that house and get a mortgage than to try to save for 100% of the price of the house that you're buying. Obviously, there's a lot of other good reasons that we can go into details about, such as student loans and things like that.
So for individuals and the families, how could they keep the spread in their favor?
So the spread means what the cost of the debt is versus what you're making on your money. So let's simplify it through an example. You have, I don't know, $10,000, and you're looking to maybe buy a used car that's going to cost you $10,000. So you have the option to borrow the money, right? Go to the bank and get a loan and use the bank's money for the car, or you can use the money that you have in your savings. So let's say you go to the bank and you ask about borrowing a loan for the car, and it happens that the cost will be 9%, for example, per year. That would be the interest rate that the bank is going to charge you. If your money is making a lot less than that, so let's say you have your money in a savings account that's earning you 3%, then in this case, the spread is 6%. That's the 9 minus the 3. And in this case, it's not in your favor, right? You're collecting 3% on your money, but you would be paying 9% to the bank if you borrow the loan for the car. So in this case, considering all other factors held equal, it might make sense for you to use your cash to pay for the car instead of borrowing the money for the car.
Okay, so when starting the video, I'm sure many people's conception with that is a bad thing. But after talking with Sammer, we learned that for both individuals and for families, that we could utilize that to our advantage in some situations. Now that we have that understanding, we can look at the different types of debt that usually affect typical individual and families, which include mortgage debt, home equity lines of credit, auto debt, student loans, and credit cards. So first things on the agenda is mortgage debt. Right now, interest rates have been increasingly high. They've been higher than they have been in a long time, especially after coming out of COVID, where we had record low interest rates. This is leaving a lot of people not knowing what to do in terms of their mortgage loans and how to tackle the situation with high interest rates. So how should families approach the decision of taking out a mortgage?
Specific question that you have to ask yourself: do I need to buy the house now? And do I anticipate the prices of those homes appreciating in the future? So if you think that you have to buy the house now and that these prices are going to continue to appreciate, then obviously in this case, you're going to go out and borrow to buy the house, regardless of what the current cost on the mortgage is, regardless of where interest rates, because you're trying to protect yourself from waiting and buying the house at a more expensive price hoping that interest rates will go down the line.
So main question is, do you need the home now? And do you think the prices of homes are going to go up? At this rate, considering the current demand for housing and the lack of houses that are available, it's probably safe to say that houses are going to continue to increase until they start putting more houses on the market. So now that we understand those two questions, you should ask yourself, can you break down the main components that go into a mortgage?
Sure. So when you're applying for a mortgage, obviously various factors that you need to consider. For example, how much money you're borrowing. Are you borrowing 80% of the price of the house? Are you borrowing 90% of the price of the house, and so on and so forth. The second option would be the term. Are you going with a 15-year mortgage, or are you going with a 30-year mortgage or a 40-year mortgage in certain markets? The interest rates obviously would be very relevant. How much is the cost per year? And is that rate fixed or variable? So when we are at a high interest rate environment, and right now the Federal Reserve is telling us that they may be lowering interest rates later in the year. So considering what the Fed is telling us and assuming that they are telling us the truth, then if we expect interest rates to decline in the near future, or maybe next year, or so on and so forth, then you probably do not want to fix the interest rate on your mortgage today. Maybe get a variable rate mortgage, and potentially if rates do decline down the line, then so will the rate that you're paying on your mortgage. So that's one way of doing it. Another way of doing it is also to get a fixed mortgage rates and potentially consider refinancing down the line if it makes sense for you.
Okay, so how does the ability to refinance affect the ability to take out a mortgage?
It's important to know when you're doing your mortgage on the house today to realize that you're not necessarily going to be keeping this mortgage for the next 30 years or for the next 15 years, meaning for the full term of the loan. You will always have options. Even if the mortgage that you currently have is a fixed rate mortgage, you can always go in and refinance that mortgage. Yes, there will be added costs if you go in and refinancing. They call them closing costs and other things. But a lot of times it may make sense for you to refinance even if you're incurring new closing costs, because potentially interest rates have declined quite a bit. So that's why you don't want to just let the price or the rate of the mortgage be the main factor for you to deter you from buying a house today. If you're in a hot market and you think that market is going to continue to be hot, then you probably would want to get that house today and protect yourself from potentially increasing prices of those homes.
So I know a common worry for people when refinancing is it will affect the term of the loan. Is that something they should be concerned about?
Not really. You can have a 30-year mortgage today, and let's say a couple years down the line, interest rates have declined, your income went up, your ability to pay on the mortgage is higher, so you can refinance into a 15-year mortgage at the time, right? So you have the flexibility. Each time you refinance your mortgage, it's like applying for a brand new one. You still have all the choices out there, from the terms to the different variability versus fixed, and so on and so forth.
So when talking about mortgage rates, we also hear another popular term, that is home equity lines of credit. However, not a lot of people know exactly what that means. Can you break that down a little bit?
Sure. Home equity line of credit, or also known as a HELOC, it's effectively a mortgage, a second mortgage on your home. If you already have a first mortgage, then it typically sits as a second mortgage. It basically allows the homeowner to borrow against their equity in the house. Okay, so what does that mean? Think about it as like this. So let's say you have a house that's worth $500,000, and let's say your mortgage balance, so you have a first mortgage on the house, and the current balance that you owe on the mortgage is $250,000. And in my example, it's $250,000. So you don't have to sell the house. You can go to the bank or to a lending institution and say, I am looking for a home equity line of credit, and they would look at your equity in the house. So in my example, it's $250,000, and they can lend you potentially up to half of that, or maybe 70% of that, or 80% of that, whatever the limitations are set by that lending institution. And it's typically a line. A line means they're not giving you the money, you just have access to the money. So they may give you a checkbook or a debit card, where if you need any money, you can go in and access the line. And typically that having the line doesn't cost you any interest until you start to pull from the line or borrow from the line. So think of it as a way for you to access money, and you would only pay a cost on it if you access it.
So what are some common characteristics that homeowners should know about HELOCs?
So a HELOC, like I said, it's a mortgage. So a lot of the same characteristics as the regular mortgage, right? It has typically a term. Most HELOCs are 30-year mortgages. okay? But they have what is called a draw period. A draw period is the number of years that the lending institution is allowing you to go in and access money out of that line. Most of the time, it's at 10 years. So it's the first 10 years of the 30-year mortgage, right? So typically what happens after 10 years, if you have a balance on the mortgage or on the HELOC, then you can continue paying on it. You just can't draw from it anymore. Obviously, the interest rate is another characteristic. 9 times out of 10, an interest rate of a HELOC is variable. So it goes up and down with interest rates in the market. So that could work for you or against you. Like if we're looking at it now with rates being high and they're projected to go down, then that could work for you if you access the money down the line.
So, in your opinion, under what circumstances do you think that a HELOC would be good for someone? Obviously, everybody's situation is different, but in a general sense, what would you say?
Yeah, generally speaking, and obviously, we cannot make a general recommendation that would apply to every single person out there. But most of the time, it's a very good way to have access to liquidity if you need it. Typically, I tell my clients, you can pay more on the house. So effectively, you're turning your liquidity into brick and mortar, right? It's not always easy to do the opposite, where you're turning your brick and mortar into liquidity, because that could potentially mean you selling the property, or maybe if we're in a recession and the lending terms by the lending institutions have been tightened, they may not easily give you a home equity line of credit. So I would say that a lot of times it's a good way for you to maintain access to liquidity if you need it. Think about it this way. Let's say an opportunity for you to do some home improvements on your house, and interest rates are low, and it makes sense for you to borrow that money to do the improvements versus using your own cash. That could be a good way for you to utilize your HELOC on the equity of your home.
So, you talked about a draw period of 10 years. What happens after 10 years if you still need to access the money?
That's a very good question. So think of it this way. Let's say you have a HELOC and you have a balance on it, and you've held it for 10 years and you're making your payments along the way, but the 10 years have ended, meaning you can no longer pull money from that line of credit, but you still have a balance on it. And let's say you think that you might need some additional liquidity down the line. So one of the things that you can do, just like you can refinance a mortgage, you can also refinance a home equity line. So you can go to the same lending institution that you have, or you can go to a different one and say, hey, I have this home equity line of credit, I'd like to refinance it. And effectively is they're replacing it with a brand new one that will come in with a new 10-year draw period. And they may work out on the balance and either add it to the new one, or maybe they can segregate that into a separate mortgage. There's all kinds of ways of doing it. But it's just like a traditional mortgage, it can be refinanced as well.
So we looked at the different variables of mortgage loans and HELOCs. Now let's transition a little bit to a different field, auto loans. What are some pros and cons on taking out an auto loan versus just buying the car outright?